Hey everybody, welcome back to another beautiful day in real estate. Today we've got a lot of stuff to cover. Yesterday we got a little sidetracked on focusing on explaining our plan to our first million. Now, when I started in real estate, my goal was to become successful in real estate. Now that I'm starting to see success in real estate, I'm going to be focusing on the next step, which is generating wealth for my family. I spent the last 2 years focusing on how can I be the best at a real estate career? How can I be the best realtor, understand the market the best, understand the economy the best, and be the number one salesperson in North Dakota for new construction? And now that we're getting to a point of understanding, I wouldn't say we're the best by any stretch of the means. I've been blessed with the ability to learn and help as many people as I can. And now we're getting to a point now where we can kind of expand on it. So if you want to know the story, follow the story a little bit, understand where we're coming from, why we're building what we're building. The video from yesterday is a great video to be paying attention to. But without further ado, we're going to talk about interest rates right away. Interest rates 6.5 for the conventional average, national conventional 30-year, and then the FHA and VA are still under 6%. Now, I got to clarify, these are averages, right? So again, it depends on the lender, it depends on if it's private lending, if it's a broker, if it's a bank. All of these are going to factor in differently. What you start to realize when you're in real estate is that I meet with a lot of different lenders, and different lenders have different products. Now, I didn't know that before I got into the space, and most people don't know that, right? Like most people go to their bank. Here in Bismarck, it's Gate City Bank. A lot of people bank there. They are pretty big. They're a pretty big market share when it comes to lending for houses, right? So they go there. The thing that people don't see though is that although I love working with Gate City Bank, sometimes their origination fees or their fees are going to be higher than somewhere else. When you work with different brokers or different lenders, you understand that this bank over here, like US Bank, they're really good at having lower closing costs, closer to 2% of the actual purchase price versus the average is going to be 3%. If I go to a different broker, he has the capability to essentially approve people on a more particular basis rather than what a bank's going to do. Sometimes my clients will go into their bank, their personal bank, whether that's Gate City, Dakota Community. I know none of you know this because most of you aren't from North Dakota, but local banks, and those local banks, they do have good programs, but interest rates might be higher, or they might have higher closing costs, or you might have to pay an origination fee, right? And sometimes they get approved for say 350 because the bank will only be credible to a certain amount of income that you have. If you go to a broker with more capabilities, they're going to expand on that. They're going to be able to hone in a little bit more, and not necessarily they're going to be able to stretch your capabilities of buying. I've seen people go in and get approved at a bank for 350, work with my guy, and then at 425, 450 is where they end up. It's not that gap's usually not that big, but it does happen, right? So when it comes to interest rates, the more I get into real estate, the more I understand that it's really not about the interest rates. It's about the lender you're working with. And we're going to do some shorts and some reels this week talking about that because it's so valuable that nobody talks about it. But dude, if you're not with the right lender, it's not going to be a good process, right? It's like any machine, any system, right? When I talk to people about building homes, my owner is a very systematic based person. So when we build houses, I have a 6-step process to building your house. 6 steps, simple, right? You follow step 1, step 2, step 3, step 4, step 5, step 6, and it gets you through the process as smoothly as possible, right? It's always going to be stressful to build, right? Or move. But if you have a process set in place, it makes it so much easier because now you can give the buyer or the customer the expectation of what next steps are, what the time frame is, and what you should be expecting along the way. It's the same thing with working with a lender. If a lender doesn't have a process on how to get the best deal for you, chances are there's a better lender out there. I interview lenders every quarter, and then I have a list of 2 or 3 that I use. Not every lender stays on there every quarter, and it's not because they're bad. It's just because when I sit down with you, no matter what, you need to be on top of your game, number one, right? You need to be answering your phone. You need to be making sure that clients and customers are a priority. And also you have to know what you're doing. Because there are times that I've sent people to a lender and maybe they didn't jive. Maybe personalities didn't jive, right? So then we have another one on the list you can go talk to. But every quarter I sit down and I say, hey, what sort of value can you provide to my customers and my clients in this year? And a lot of people don't think about that. They just push to a lender because they're friends or because they're like, yeah, I use this one when I bought a house. Dude, like you got to be very particular about who you're sending people to, right? Your reputation rides on it. So we'll do some shorts. We'll kind of dive into that over the next couple of weeks. But let's jump into oil prices and talk a little bit today. Oil prices sitting right around $100 a barrel. This is WTI crude oil, the US dollar. So there are a couple different crude oils and they can vary in value, but this one I follow the most. But we saw $115 a barrel, right? Once, twice, didn't break above. We saw another push up to 100 and about 810, and then we rejected there. We bounced slightly after we were supposed to see the end of the war, and then the war continued, and now here we are at $100 a barrel. What happened is there was a negotiation, an apparent negotiation with Iran, and they provided a rebuttal that didn't fit what the United States and Trump was looking for. So now we're back to a standstill. Strait of Hormuz is essentially just completely blocked off, and I'll talk about it every day, but people don't realize how detrimental that is every day that strait stays closed. See, the problem is, and this is again why I'm going to focus on real estate is very important, because the reality is one of two things, right? We have two things. One, they open up the Strait of Hormuz and we print a bunch of money and the markets rip, right? Or the Strait of Hormuz stays closed and they strangle off supply chains to the point that it can lead to a global recession in one shape or another. There's a ton of product that flows through the Strait of Hormuz, not just oil. And the longer that it stays closed, the longer it's going to be to recover over a period of time. If the Strait opens today, it doesn't mean everything's back to normal. It means that everything is going to be different for a time, and they're going to try to regain normalcy, right? They're going to try bring up the amount of oil production going through the Strait. And I talk about oil production because that's the majority of what goes through a Strait, right? Lots of other things do, but for time's sake, let's talk about this, right? So when oil stops, obviously it restricts in a lot of ways. It restricts the ability to create jet fuel, right? Which means plane tickets get more expensive. It means that gas prices go up, which means I saw a post on X the other day, and it was a truck driver who delivered one load, and it was $4,000 in fuel for 4 stops. It was $1,000 a stop, right? When you see, now imagine gas was at $2.79. Let's just say $3 for the sake of argument, and it's at $4 now. I know there's a variation, but you're talking about a 30%, 25% to 30% increase, right? Imagine paying 25% more for gas in your vehicle, and that's your business, right? All of a sudden, your profit margins are now falling, so you have to create a higher bill. So now transferring product becomes more expensive. When transferring product becomes more expensive, now you're paying $10 for noodles. I say that because I paid $10 for a box of noodles yesterday, or my wife did. I'm just blown away. We're talking about it, and it was $10 for a box of noodles. It was $10 for a jar of marinara sauce or whatever. It's because things are good, and that's the reverberation of what we're seeing, right? It's not just oil prices, it affects everything across the economy because oil is the base structure of every economy. Without oil, you can't have gas. Without oil or gas, you can't have product. Without product, you don't have food. You don't have clothes, shirts, things being transported, right? Ships need oil to, ships need fuel to be able to do their thing, right? Planes need jet fuel so they can transfer product and transfer people. Like when you cut off something like this, it doesn't just negatively affect your local gas station. It affects the entire world economy. So until we can see some sort of stability that heads south or heads down, we're going to see these elevated prices. Trump's proposed a bill, or is asking Congress to propose a bill that would suspend the federal tax on gas, which would be 18 cents a gallon, which is pretty big, right? But the reality is, if it goes up to $6 a gallon, I mean, 18 cents relatively, I mean, you're still paying double, right? So until we see some more positive notion of of oil prices going down, which I just don't see as of right now, especially with the core inflation. Like, okay, let's just talk about CPI real quick. So CPI came out and inflation rises to 3.8%. It's the highest level since 2023. Core CPI inflation rose to 2.8, above expectations at 2.7. We are experiencing post-pandemic inflation levels and surging oil prices. Odds of Fed rate hikes are surging. So we went from a year of potential 3 rate cuts to potentially seeing a rate increase. Now, that's not all bad, but it's not great, right? Because if interest rates go up, you're going to see the real estate market slow down again. The real estate market now is getting normal, feeling normal. People are all buying homes and they're getting comfortable around that 5.5%, 6% interest rate. if we change back to a point where interest rates are in the sevens and the market slows down again, there is chances that it's going to be harder for people to sell homes. I'm always going to be a firm believer that a home will sell in any market depending on how you price it. It's your responsibility as an agent to really sit down with your customer and say, or client, and just say, listen, I know your home felt like it was worth $650,000, but in this current market, it's worth $600,000 or $599,000. That is the problem with the real estate market, right? Because people comment on my videos talking about how realtors inflate the price for real estate. I disagree. If anything, I'm always trying to convince my clients, and I do, that listing it at market value is where we need to be more times than not. And I'm not dogging on my customers or my clients, but they want to list higher because they feel their home is worth more, right? It's not always the case, and it's our responsibility as real estate agents to be able to do that. But anyways, I mean, right now the CPI numbers came out. They weren't exactly great numbers. They were rated expectation as far as CPI inflation was. Expectations were 3.8%. We're at 3.8%. So we're up about a solid 1% a year since the beginning of the year. Seems like a small number, but that number adds up, right? And remember, when it comes to CPIs, they pull the data from specific. Categories. It's not all categories at once. It's not the energy, and then it's not, like groceries and then travel, and like they don't take every single category. They cherry pick, right? So some categories are going to be substantially higher in inflation, some are going to be lower, but they're going to typically go for the lowest inflation so that the numbers look better on paper. That actually doesn't mean that everything's only going up 3.8%, right? We've seen gas itself, energy, go up 30% in the last month, right? So what we should be focusing on and paying attention to, more importantly, right now is, in my opinion, the disconnect with the S&P 500 versus the rest of the world. The S&P 500 is at a new all-time high, opening up today at an all-time high, right? So we've seen at open 7,436 for the S&P 500. We are getting to a point where we opened up, like we talked about this trend line has been in effect all the way back. Now, granted, we saw double top. This was the peak of 2021's bull market, right? But all the way back down to 2009. 2009 is the bottom of this channel, and ever since then, we've been on an upward trajectory in there. We had one break below here. This was COVID crash, right? So this was a bit of a unique situation. Then we saw the peak of the bull run in 2021, and then we saw our retracement all the way down to essentially the bottom, and then we've been working our way up since, right? So let's get rid of this because it's not relevant right now. But we saw, now if we had our line down the middle here, right? So I'm gonna try and do this real quick, like on the camera here, right? So let's do this. All right, let's do boom. Let's do this. I'm gonna try and level that out. I know it's not gonna be 100% accurate, but you guys, I'm not gonna go through and build a channel out today. I'm just gonna do this. All right. So that is not even close to what we needed. There we go. For God's sakes. Let's try that one more time. All right. Well, I'm not even going to try that right now. Anyways, so the long story short is we're breaking above this channel, right? We're breaking above this channel. By seeing that, this again is a disconnect because everything else feels so not positive, right? You got the war in Iran, you got the war in Ukraine and Russia, you've got issues with the debt crises, you've got the loan crises for car loans, you've got debt crisis for college debt, you have people that can't afford houses, the housing affordability is through the roof, unaffordability, right? But the S&P 500 is at all-time highs. Why? Because right now we're on the verge of witnessing a blow off top in the S&P 500, which is essentially the peak of the bull run for the S&P. And the reason it's doing so substantially well is one category, one particular area, technology. Because AI has been so effective as far as growth that you're starting to see that progress into the stock market. It doesn't mean that things are looking very, very good. It just means right now on paper, they're showing a significant amount of profit, and the valuation of the companies are continuously getting bigger and bigger and bigger. Now, if we compare this to the 2000.com bubble, this is the same concept that happened with the internet. The internet came out. Everybody thought that it was going to be, I mean, it turned out to be one of the greatest things of all time, right? We use it all day. We have a computer in our pocket 24/7. But just like everything else, it gets overhyped, it finds its peak, and it falls right off. Now, AI might see a bigger bubble, but the opportunity to see a crash on the back end of this year, the end of next year, somewhere between the end of 26 and the end of 27, I expect to see some sort of crash. Do I know when? No, I don't. But if a blow off top happens in the S&P and it essentially peaks right around election season in November, right, and then it kind of falls back off, then we'll kind of know. But when this peak happens, and it will, people are not ready to see that yet. People are not going to be ready. And right now, Warren Buffett has 80%, or Warren Buffett's company, Berkshire Hathaway, 80% of its capital is cash right now. If that puts any perspective in your mind, if there's anybody you should be paying attention to, you should be paying attention to one of the greatest investors of all time, Charlie Munger, who passed away, and Warren Buffett, two of the most great investors of all time. And then you just notice that Warren Buffett steps down this year, and now his company, his old company, holds 80% of its capital in cash, over $300 billion. Something to be paying attention to, right? He feels that the world's gambling more than it ever has before. Now, here, I want to talk about real estate next real quick. I want to go over why real estate why 2008 and 2026 are different, as we've talked about before. Existing home sales over the first 4 months of 26 were the lowest since 2009. Now, remember that year for a second. In April, 4.02 million existing homes were sold on an annualized basis, according to the NAR's data. The figure was below last year's and the lowest since 2009 in the midst of the great financial recession. Buyers continue to exit the U.S. housing market because they don't want to pay today's sky-high prices and can't afford to, making the fourth straight year recession-level home sales. Depending sales figures in April and May suggest we might finally see a bump next month, but it's hard to think that as more than a dead cat bounce. Given how bad the first 4 months of the year were, lower prices are the only way buyers will come back. Let's talk about that for 1 second. 2009 was the midst of the financial crisis, and we had the lowest sales currently. So when we're getting to levels of that nature, but we're still seeing an inventory shortage. How are we expecting the market to crash? Now, I understand bigger metropolitan areas, and there's a graph that shows up everywhere, and it says that all-time highs, like 630,000 more sellers than buyers right now, right? But you have Trump, who came out in multiple different times and said he doesn't want housing prices to go down. He wants people to keep the asset wealth in their properties. So they're going to work on different ways to bring down and create affordability for buyers. And I just don't think they're going to crash prices. And this is maybe my optimism hat on, but the one guy who's in office right now built his entire wealth around real estate. Do you really think they're going to collapse real estate while he's in office? Like him, hate him, whatever. Look at it from a businessman's perspective. They're not going to crash housing prices to succeed. They're going to figure out different ways to create more money for their pockets. Let's be real here, right? This guy's not in the office just because he's the number one guy and he's a big Christian and blah, 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 whatever you guys want to believe about him. He's going to make more money, period. And by crashing the housing market, he's going to decimate his own portfolio. That alone shows confidence in the real estate market to me, because again, I'm going to look at it from a businessman's perspective. We're not going to crash our companies. They're going to figure out a way to continue to see them grow, right? So buying real estate is very, very important to me, because now is the time to be buying real estate. You can go across the board here and argue that, the housing market's going to crash, but they've been saying that for 5 years. And remember, typically what the majority of the world thinks, or the country thinks, the opposite happens, right? So what does that mean for real estate? It just means that this summer, more than likely, we're going to see some sort of shift towards the real estate conversation, and we're probably going to see some way for housing to be more affordable. It may not be exactly interest rates coming down. It might be supplemental income from the government. And it might be the Trump homes, the 20 million Trump homes or whatever they were planning to 1 million Trump homes, 1 million Trump homes. They've removed red tape for builders, which means probably subpar building, right? I mean, you pay attention to all of these, they're working on those factors. They're just not major headline news yet. It'll come, but I still think that the real estate market's stronger than any other market currently. Now, lastly, before we hop off, I know we're getting to our time. I can kind of talk forever here, but the massive disconnect between wealthy and working class as it continues to get worse every month. How does this end? So what happened is during COVID, especially, right? Because you go all the way back down to the 2024, everything was kind of in suit. And then Main Street fell off a cliff and Wall Street grew. Why? Well, it's because Wall Street invests their assets. What did they say? Maybe, I think it was like 20% or 5%. It was a small number. I think 5% of United States people or citizens of the United States are invested in the stock market. So 95% of the wealth is in the stock market, but only 5% of the average person invest in the stock market, right? So that means that 95% of people have no money in the stock market, which means they're not building wealth. Well, when you see a devaluation of such significance, right, over the last few years, the US dollar has completely fell off a cliff. Obviously, people can't afford anything anymore because they don't know how to invest. You're never taught how to invest. You're never taught how to invest your money and create wealth. You're taught to go to school, go to more school, go into debt. At 18 years old, you can get a 20-year loan on a school debt or on a loan for a debt for a diploma that doesn't even get you a job anymore. And you can have interest payments with a terrible amortization. Shows 3% interest. Don't get me wrong, 2% interest seems good on the front lines, but if you pay attention to the amortization, how much gets paid towards principal, if you're paying the bare minimum payments, you are literally paying like 30% to principal and 70% to interest. It's fucking horrible. It's terrible. And instead of trying to teach people how to get better and build wealth behind it, they just continue to push you into that. Like if you don't go to college, you're a terrible person. I didn't go to college. I have no student loans and I'm doing just fine. We're in a time where college is no longer necessary. It's more of a luxury. And we can learn anything by sitting at home, taking the time and the discipline to do so. So it's very important that everything going on that we focus on how we can start generating wealth. And I'm always going to refer back to starting with the place you live. If you can start buying something in the place you live and start paying a payment, not only are you going to see equity growth over each year, but you're also going to see that valuation of that home go up each year, right? There might be a couple years out of the 10 years you live there where it's going to go down, but it always recovers. There's never been a time where you bought a house and 10 years later it wasn't worth more than you bought it for. Stop renting, start buying, stop waiting for the world to crash, because if you do, you're not going to have any money to invest at that time. If you have money now and you have time, start learning how you can invest so you can become better so that you can start building wealth for your family. If you made it this far, thanks for watching. Make sure to like and subscribe, comment if you have any questions, and we'll see you soon.